This latest report on jobs changes everything because what it said was that the hiring rate in August fell to its lowest level since April of 2020. Yes, April of 2020. It's more confirmation that the U.S. labor market is indeed visiting Dr. Beverage, and just in time for Amazon's Prime Days, which begin about a week from now. We also got confirmation in a separate report that consumer confidence fell sharply again here in September, with consumers saying that they agree that the level of job availability is the lowest it's been in many years. So it's not just the high-level data. This thing is also making waves on the ground. During the last Prime Day, Amazon's expanded 4-day discount-a-palooza, Americans spent on household items like food and essentials. They did not go nuts splurging on big-ticket items. In fact, according to some sources, 2/3 of what Amazon sold were priced less than $20 each. And the economic situation in the labor market has only gotten worse since then, and it's in all of these various reports. It's consistent from top to bottom. This latest one shows more jobs were lost than gained during the summer, which is exactly what consumers are saying to consumer confidence surveyors. There's also more data on incomes which show exactly the same thing, as nominal incomes have slowed way down into the danger zone, the recession danger zone, and when you adjust those for prices, real private income has been net negative during these same past 4 months, and I'll show you what those numbers look like. So from Amazon to JOLTS to lack of confidence, it's just as Dr. Beverage's curve suggested, and it's what the markets have been saying and predicting and signaling all along. There is broad confirmation across all of these various and different perspectives saying we have indeed visited the flat part. What's left to figure out now is where on the curve we might be and how fast we might get to even flatter. Now, what we learned from Amazon's July experiment was that even 2.5 months ago, consumers were absolutely struggling. Now, Amazon itself always refuses to give out any data. Instead, what the company does is they put out bland platitudes like, quote, record sales and, quote, Americans got big savings. Basically, everything you already knew without needing to be told. Now, there are a few sources which have enough insight to draw at least some moderate conclusions. Numerator is one of those, and it said online sales were up big during the Prime Days, which is not a surprise since Amazon has never done a 4-day event before, so it isn't directly comparable to any previous ones. But what Numerator did report, which was helpful, was the breakdown of what it got purchased through its various surveys of those who did participate in Amazon's Prime Days. And what they found was 30% of those purchases were on clothing and shoes, 29% on household essentials, and another 26% on home goods. Even groceries registered at about 14%. Only 18% were on consumer electronics and only 12% on toys and video games. But maybe the most striking part, the part that I said in the introduction, 2/3 of what were sold were priced at less than $20, while only 3% were priced over $100. It doesn't exactly scream out consumer confidence, now does it? And before we get going further, I want to remind you, again, this is what the markets have been saying and predicting, that we were going to see something like this take place. The problem is, nobody understands what interest rates really are, especially curves, because of economics. Well, we're going to begin to change all that, and you're going to see how it's not that difficult to decode what interest rates are telling us. I'm having a webinar on Tuesday, October 14th at 6 p.m. Eastern Time. There's a link in the description to sign up. And as you can tell, it's getting more important, not less important, to understand what the interest rate markets are all saying to us. Again, the problem is economics. It's the fact that you've been given a whole bunch of information that just isn't accurate. It's more often than not backwards. Well, we're going to change all that. We're going to change that on Tuesday, October 14th at our webinar. It's at 6 p.m. Eastern Time. Again, link in the description to sign up. And this stuff, I mean, as I said, what we're trying to do now, thinking about moving forward, is how far down the beverage curve we might be going, and where else are we going to get that information than the markets that have been right about getting to the flat part of the beverage curve in the first place. So again, Tuesday, October 14th, 6 p.m. Eastern Time, link in the description to sign up. Now, getting back to Amazon, its previous Prime Days came early during what appears to have been only the start of the job shedding process. So we got the latest updates on JOLTS, which is job openings and labor turnover, though for us, the emphasis is on the second part, not the first, the labor turnover. We should note first The Bureau of Labor Statistics has already put out a statement which says if the government is indeed shut down tomorrow, there won't be any payroll report this coming Friday, the one for September. So no establishment survey, no household survey updates, which means these JOLTS figures that we're going to go over are the last we'll see of any major releases, maybe for a little while here. Now, the mainstream media always focuses on job openings, largely because Janet Yellen made such a big deal out of them about a decade ago. The Fed was searching for some estimate that made it seem like QE was working, and that's basically what they had. It didn't help that as time wore on, the job openings estimates got farther and farther into la-la land, the series becoming clearly riddled with inaccuracies like dummy listings, duplications, and a whole bunch of other problems beside. But even so, according to the latest stats for the month of August, job openings were basically flat at 7.23 million compared to 7.21 million revised for July. The job openings rate, which is job openings as a proportion of the establishment survey, was just 4.32%. Basically still right there among the lowest of the cycle so far, around the same rate as June of 2020. So even job openings are signaling things are not really that great, and that's from a heavily overstated series. But it's actually hiring that we want to really focus in on. Not only is hiring far more important than the faulty job openings estimates, it is right at the center of exactly what it is we're trying to figure out. Not just in terms of the low level of hiring in the economy, which is becoming more and more apparent and getting worse and worse, but also it leads us in the direction of finding net turnover, which is exactly what we find, net turnover in the negatives for this past summer. Now, JOLTS says that hiring in August slid to just 5.13 million. That's the lowest of the year so far, and really the second lowest since 2020, just barely higher than the actual low of June of 2024. However, when you convert that to a hiring rate, which you always should do, as a percentage of the civilian non-institutional population, hires were just 1.87%. That's actually less and significantly less than June of 2024 and is the worst by far going all the way back to April of 2020. In fact, only March and April of 2020 were lower. 1.87% is right in line with the going back to 2012 when no one was hiring in the aftermath of the Great Not Recession. And on the way down into the not recession, 1.8% is equal to December of 2008. That's what we're talking about when we see this low of a hiring rate. Real trouble in the real economy. So given the fact that no one is hiring, quite naturally, workers aren't going to be quitting either. There's really no point to it. You might not like where you are now, and no one really does, but the alternative to keep your current paycheck is going without one entirely for the foreseeable future. Now, quits, according to JOLTS, slid down to a rate just under 3.1 million, which is the fewest since last November. And even though estimated layoffs remain relatively low, at 1.73 million, it's enough to raise unemployment, leading to job shedding overall, especially when combined with these pitiful, painfully low rates on hiring. But to calculate that net negative turnover, or just net turnover to begin with, and really to reconcile JOLTS with the establishment survey, we start with the number of monthly hires, which we just went through, and then you subtract all of those who voluntarily quit their job, which is the quits number, and then you subtract further those who were laid off or discharged in some other fashion. So if you've got more people who were hired during a month than those who either were quit or fired, there's going to be a net positive gain. And when you apply a conversion factor, that net turnover from JOLTS matches the establishment survey's monthly change pretty closely, as you can see. So what we see from this past summer for 3 months running is that there were fewer people hired than were let go for whatever reason. So that's net negative turnover, which is a very rare occurrence even during the 2010 silent depression when the labor market was subdued the entire time. It didn't happen once outside of the very start of the decade, right at the tail end of the Great Not Recession. Here we can see it happening a little more frequently. It shouldn't be happening at all, but we keep getting signs of net negative turnover consistent with the beverage curve. So no wonder the Fed is back in the Pringles can like the market said they would be. There's no tariff inflation in the economy, and this is one reason why there isn't. But there does seem to be a fair amount of job losses that continue to pile up. And without a significant net positive anyway, unemployment is going to mount even if layoffs tend to be small and sporadic like all the data is showing us. And not only is the data showing us that, it is showing us that with increasing confidence. There's more chances that this is really happening in the labor market. We really are moving to the flat part of the beverage curve, and less chance that this is some kind of random fluctuation or statistical anomaly. And it's coming in from all of these directions, all over the place, including consumer confidence. Talk about confidence. Consumers continue to be not confident for these reasons. They are backing up what we're seeing in this data by saying they see the same thing on the ground in the real economy. What is a Eurodollar University membership? It's where understanding the monetary world isn't a mystery, it's a method. If you're serious about your financial education and you want clarity in a world of volatility and misunderstanding, this is for you. Mainstream education has left so many gaps on the most foundational concepts, making sense of everything is practically impossible otherwise. With our memberships, we'll fill in everything that you've been missing. Whether you're starting out or sharpening your edge, our memberships scale with your goals. At Eurodollar University, we teach you about how money really works so that you can evaluate fundamentals and make grounded decisions. With a Eurodollar University membership, you get a comprehensive library of foundational and advanced lectures, in-depth case studies and real-world analyses, live Q&A sessions, regular updates on macro trends and even some central bank policies. And most important, how to interpret critical derivative market signals you will not find anywhere else. You can't be in position to succeed if you don't know how it all really works and fits together. So if you're ready to explore, master monetary systems, both past and future, with structure, clarity, and confidence, click the link in the description to visit eurodollar.university/memberships to join us today. It's always what consumers have been saying they were afraid of this entire year. Fears over jobs and incomes. They have dominated consumer surveys, one after another, showing plummeting confidence. Jay Powell, the mainstream media, told us it was nothing more than an overreaction to tariffs, but as it turns out, it was an underreaction to actual job losses that are building up with unemployment. What I mean is, consumer confidence turned somewhat higher after the initial disruption back in March and April, when consumer confidence truly plunged. And that was understandable, given the conditions of the time. And a lot of consumer confidence is tied directly to the stock market. Not necessarily some broad wealth effect, more so people they don't have the time to pay close attention to what's happening in the economy. And they've been told that's what stocks price, generally speaking. So if stocks are down, they tend to lose confidence because they think stocks are pricing a downturn in the real economy. And then when stocks go back up, consumers are more likely to gain and regain confidence because of it. They think the stock market is rising because the economy is just fine. And that's what happened initially, but then the job shedding shows up and confidence detaches from equity prices. Some shares, and certainly share indexes, they continued to soar. Meanwhile, consumers aren't buying it because too many of them literally can't. And as workers, they're seeing what's going on in the actual labor market. So as far as the Conference Board's numbers, which is the latest batch of data that we get, latest batch of grim data that we got, consumer confidence overall fell by nearly 4 points here in September, but it was really the expectations index and what consumers said about lack of jobs. The index fell 3.6 points down to 94.2. The present situation index, based on consumers' assessment of current business and labor market conditions, fell by 7 points in September. The expectations index, which is based on consumers' short-term outlook for income, business, and labor market conditions, that one fell by 1.3 points to 73.4. And as the press release notes, expectations have been below the threshold of 80 that typically signals a recession ahead all the way back since February of 2025. And according to the board's senior economist, the present situation component registered its largest drop in a year. Consumers' assessment of business conditions was much less positive than in recent months. Again, that's the payback period emerging. While their appraisal of current job availability fell for the 9th straight month to reach a new multi-year low, consistent with what we saw in the JOLTS hiring data. And that's what they say. This is consistent with the decline in job openings, when it's really consistent with the decline in both turnover, net turnover, as well as hiring. And she continues, Among consumers' write-in responses, there was a rise in mentions of jobs and employment to a level unseen since last August, when we were going through this very same stuff before the artificial high came in. The comments were mostly negative, especially when referring to the current situation. There were a few positive comments, which mostly conveyed hopes that things would get better. And I really hope those hopes aren't tied to rate cuts from the Fed, though in all likelihood, we both know that they are. And as Steve and I were talking about on Sunday, if the only hope you have left is Jay Powell, you really don't have the hope that you think you have, and you really don't have much hope at all. And that point is really emphasized when we look at the income statistics. So not only do you have consumer confidence that is rolling back over and falling lower again, you have net negative turnover according to JOLTS. You've got the establishment survey, the household survey, rising unemployment, especially when adjusted for labor force dropouts. You've got the labor force dropouts to begin with, and now you've got the income statistics that corroborate all of it. Now, the Bureau of Economic Analysis, the same folks that put out GDP, last week, they reported a continued slowdown across incomes during this same period that we're talking about, the summertime of more and more recession numbers. Nominal personal income, which includes everything in the economy, meaning it's the top level for all incomes, that one grew by just 2.2% over the past 6 months, up to and including the latest statistics in August. Now, that's already a sizable slowdown from the previous 6-month period, which had grown by a 2.8% rate. But over just the last 3 months, the 3 months so up until August, nominal income slowed to just 1%, firmly in the recession danger zone and absolutely consistent with a labor market that is losing on net more jobs than it's gaining. And these comparisons are even worse when you account for transfers. Excluding government payments, nominal private incomes increased by just 1.7% over the last 6 months and only 0.8% over the last 3 months. And then you take it a step further and adjust the same data for price changes and real personal income excluding transfer receipts. Those have been barely positive the past 6 months because that data has been actually negative during the past 4 months, going back to April's chaos. So you get to April, the disorder, and then ever since then, as the job market falls off, real personal income in the private economy turns negative. So these are exactly the kind of income results you'd expect for a labor market that is losing jobs and sadly stacking up unemployed. Now, for Amazon, getting back to the beginning here, that could actually be good. If discounts are the big draw here, then drawing down prices might mean a volume and business boost that's actually aligned with the current macro climate. That's kind of what we saw in the prime days earlier this year. It's not about splurging, it's about stretching, giving consumers deals that actually match what they have and what they're willing to spend. But that could also be a double-edged sword. A lot of stocking up on necessities and the like during the prime days, but maybe at the expense of overall holiday spending. Pull forward too much activity to give, deals on necessities. Maybe there's not enough left over for the juicier items that are normally sold during the Christmas rush. And that seems to be the key takeaway from the past prime days, where it was all about necessities and bargains at the expense of, what seems to be the expense of, the bigger ticket, higher value, higher profit items. But Amazon's problems aside, the economy's problems are, you can see, far greater. By all accounts, and I mean nearly all of them from a broad array of sources, the data says the U.S. labor market is almost certainly losing jobs, and it has been for some time. Exactly how many jobs and for how long, we don't really know because these macro accounts just aren't that precise. However, from these various data series to consumers themselves, there really isn't much remaining doubt about being on the flat part of the beverage curve, which is right what the markets have been pricing and predicting this entire time, along with predicting that Jay Powell is going to go farther and deeper into the Pringles can. As the labor market goes flatter and flatter on beverage, the farther down the Pringles can Jay Powell is going to go, along with the markets going with interest rates lower and lower, a lot lower, and staying there a lot longer. One other place where we see confirmation, that's the auto industry. Went over the details, and there were quite a few of them in the video link below. As always, thank you very much for joining me. Join me Tuesday, October 14th, 6 p.m. Eastern for our webinar, link in the description. As always, huge thank you to Eurodollar University members and subscribers. And until next time, take care.